I said it yesterday and today happened. What had happened was volatility increased for the day. And a lot of this volatility was driven by what we were expecting today out in London, the trade talks, the meeting between China and the US. And the market was really hoping to hear about this. So there was a lot of optimism in the markets. AI and chip stocks were primarily the main beneficiaries of this optimism, and I was kind of thinking about why and running through scenarios in my head. And there are trade restrictions from the US to China about restricting these AI chips being sent over to China. So maybe the market was thinking, hey, maybe if the US kind of relaxes a little bit, we'll start sending some of these AI chips over to China, and then these AI stocks will do pretty well. So that's probably just the market guessing, but that's kind of where we're at on that. What we didn't get are any talks about it from Trump, which kind of worries me a little bit because, he's the first person to come out and make some Truth Social post and talk about how great everything's went. With him not making any posts about that, it kind of worries me about how good or how great these negotiations really went. We did get Kevin Hassett come out and talk to CNBC. He's the director of the National Economic Council. And what he told CNBC is that he expected a short meeting and that both countries would be relaxing its export controls. So that really falls in line with what we just talked about. Hey, you could have some chips. Hey, US, you can have some rare earth minerals. So the end. Now, the market is completely clueless. They're just as clueless as the Fed is right now. So I'd say the approach that a lot of people's taking is, hey, I'm not going to necessarily stop buying the market, but I might lightly keep buying. I don't necessarily want to sell it. I might put some stop losses or something in place. But for now, we're going to keep on lightly buying. We're not going to load the boat, go all in margin, and we're not going to dump the whole portfolio and go completely cash right now. And we're also seeing going into summer that there's less trading volume going on. That's not necessarily bad for share prices, at least in the short term. But right now, where we're at, and let's go back and look at the stocks while we talk about stocks. Let's pull up the 3x3 grids. Let's pull up Tesla. I'd imagine they did pretty good too because of China. That's Tesla's other main market, China, right? So if trade with China is going pretty well, the willingness to buy a Tesla and the willingness to trade for purposes of Tesla are better. What's another one? Nvidia. Nvidia had this little rally to start off the day, but it kind of dumped maybe because people were waiting for news. It was right around 11 when it happened, when the dump happened, and the meeting was around 11, I believe. I don't know what time zone it was expected to happen at, but I remember 11 o'clock being the time range. So I'd imagine it falls in line with that. Let's pull up AMD. That's another chip stock. Yeah, looked pretty well, and I also seen some news earlier about about Nvidia. This could also be a potentiality about why there's such the larger sell-off in Nvidia versus AMD. For one, AMD's playing catch-up to Nvidia, but I read somewhere that Nvidia's superior chips are still non-negotiable. We're not sending those over to China, but some other chips we will. So that could probably be why AMD was in the spotlight today. Let's look at Apple. We had that Apple event. They're still lagging back. Yep, they're lagging AI. They added some cool features, but hey, big deal. They're just catching up to what Android's been doing. How did Amazon do today? Yeah, Amazon did primarily well. If trade relaxes and opens up, that's a good thing for Apple. Bitcoin did pretty good, so BTC USD, that one was trading pretty well, and I had some thoughts, maybe they'll come back to me. Oh yeah, about the US dollar and the weakness regarding the dollar, so we're going to get into that here in a bit. Overall, the NASDAQ 100 QQQ ended out the day positive. A lot of iffiness, and that goes into what we were just talking about, that people don't want to sell all of their stocks, but they don't want to go load the boat either. And with stocks being at near all-time highs, I could see why there's some type of suspicion. Let's see how TLT performed today. All right, all right. So it ended out the day slightly positive, and that's, when did this happen? Right around 11. Wow. So we could see this just looking at the charts. The market kind of sold down around that 11 range, and because of the uncertainty, like, man, I need a safer bet here. So they went into treasuries. I wonder how gold did. XAU, USD. Interesting. We kind of seen some flight out of some of these stocks. I mean, it wasn't like dramatically terrible or anything, but you know, just kind of selling a little bit, lightening the load, and going into some of these more safe haven positions like TLT, these 20 plus year treasury bonds, which are yielding pretty good right now, and then gold. And then Bitcoin did pretty well today too. And this is all in talks of, while there's tons of articles coming out talking about how the dollar is weakening. And then the iffiness around the stock market as a whole. Like, we talk a lot about QQQ, the Nasdaq 100, top 100 companies here a lot. The S&P 500's earnings, expected earnings that analysts are expecting, is 22 times earnings, pretty much where it's at right now. And the main concern right now is with stocks being at an all-time high. We've really bounced since April, or whenever we really bottomed out for this cycle, and switch turns, flipped the light switch, and then just rocketed back up. There's a lot of sensitivity right now in the markets because, like we were just saying, buying light, not selling a whole lot, and less trading volume. And all of that has its own ways and adds to the factor that we're talking about here. But with this sensitivity, I mean, maybe markets break new all-time highs pretty soon, but that just lightens the load of the inevitability of a potential reversal and people taking chips off of the table. Now, if earnings disappoint, it could give the green light for a sell-off to happen. And there's a lot of worries that play into that happening because we got the big beautiful bill expected to get passed. I believe July 4th is when they're wanting to get that signed into law. What is that going to do? Increase the national deficit and increase the rate at which the government has to borrow money, and they have to increase yields, and that increases the cost to borrow money and slows down the economy, which is kind of bad for company earnings. The borrowing costs go up. Gets a little tight in here. Like, imagine I had this top button buttoned up, like this is kind of tight. Like, I could barely breathe. The market wants something more like that. And then what's another trouble we're still dealing with? Tariffs. And what do those do? Increase the rate of inflation. And we're going to talk about inflation too in this video because we got CPI coming out pretty soon on this Wednesday. But what does increasing costs do? Well, increasing costs. Increasing costs, that's what the Fed was fighting. They were fighting inflation. And if costs keep on going up, the Fed might not cut rates. So rates still stay high, including the fact that bond yields are already pretty high and could keep on trending up. We don't technically know. Like, this move in TLT wasn't necessarily a huge move, just slightly bit. And I mean, gold went up for the day, but it still ended out the day negative. So I digress. But with all of this stuff coming in, and whether or not stocks will be able to live up to these earnings expectations, which are pretty high. I believe this 22 times earnings is the highest. The S&P 500's expected earnings by analysts to come in as the highest it's been since 2002, right before another sell-off, I believe. So with all of these concerns on the table, it's stagflation everybody's worrying about. And what are the two main worries regarding stagflation? Well, when stagflation occurs, it's because inflation is high. And we're about to talk about inflation, but we just talked about two things that technically cause inflation: government spending and tariffs. And both of those are expected to increase inflation. And then another one is slower economic growth and the labor market tending more towards increasing unemployment. Now, let's talk about CPI because we've got CPI coming out pretty soon. With CPI, what we're expecting might come in a little hot and continue that trend as we head off into the summer. What we're expecting for CPI, for core CPI, because that's what we're going to be watching. So Wednesday, mark your calendar, 8:30 a.m. Eastern time for core CPI. We're expecting it year over year to come in at 2.9% from 2.8% the month previous. So we're going to be watching this, and this is showing in May. So this kind of includes some of the tariff effects that may have built into these numbers and kind of inflated them a little bit. But the bottom line here is that inflation is trending further away from the Fed's target of 2%. This increase in CPI technically isn't what the Fed watches. They watch PCE, personal consumption expenditures. But if CPI increases, I mean, heck, would it be crazy to expect the thought of PCE increasing itself? Not really. So that's not good as far as the Fed's fight. So inflation increasing. We also got some more stuff regarding inflation today. And this might kind of lighten the load of the higher CPI we're expecting to come in over the months of summer and maybe even last longer into the end of this year because of these crazy tariff swings. We don't know that. But a survey from the New York Fed surveying consumer expectations showed that inflation expectations by consumers for a year out land at 3.2%, which is down by about 0.4 percentage points from a month ago. 3-year inflation expectations fell to 3% from 3.2%, and 5-year inflation expectations fell to 2.6% from 2.7%. And I'm looking at these numbers and I'm like, wow, like 5 years inflation is expected to come in at 2.6%, at least what consumers are thinking. I mean, like that's close. That 2% is pretty close to the Fed's target, right? But 5-year inflation expectations, that's probably not great in my own unprofessional opinion, right? The decline comes after, oh yeah, so this survey was after some of Trump's tariffs were walked back. So that could have probably made people more optimistic. And usually inflation expectations and inflation itself is more so self prophesized, self fulfilled. When people expect it to happen, that's usually what they're given. So, I mean, in a way, that's kind of goodish news. But we also got more on inflation because remember, we got a 50% tariff on steel and aluminum right now. And what is this expected to do? Well, when you go to the store and you go get like some canned corn or canned beans, what are those cans made out of? Exactly. So Americans are expected to pay more for canned goods, raising costs by about 9 to 15% according to Consumer Brands Association. So more money coming out of consumers' pockets. Just think of that, more inflation. This is expected to cause more demand for plastic packaging instead, which I don't know if that could cause price pressures here, like as far as plastic goes, because more demand for, like, let's say more demand for plastic, technically that could raise costs up, just like when a ton of people want to rent apartments typically raise rents when more people are in the market to rent an apartment, right? So I'm just curious about that. And according to responsiblealpha.com, 84% of US plastic production is in the US, so in Texas and Louisiana. So tariff concerns won't necessarily be an impact here as much, but rather the companies raise prices because they can. So I just thought that was interesting and wanted to point it out. So we're expecting inflation, CPI, to start coming in hot over the next few months, especially as it's getting hot due to summer. And that's just one variable that plays into these stagflation fears. Now, what's another one? Well, the labor market. And although the labor market has been holding up, like as far as unemployment goes, there hasn't been a ton of unemployment. There's this report that I read on Barron's by Claudia Somm. Well, It's by Reshma Kapedia. It's a bleak job market for new college grads. These are the unluckiest. And the reason I mentioned Claudia Psalm is because in there she's quoted. But before we get there, I want to kind of talk about the labor market. Right now, unemployment's really sitting where it has been. I believe the last report, unemployment rate was still 4.2%, which is where it's been for the last 3 consecutive reports. So that's not a big deal. Hiring, like hiring ain't booming, but people aren't losing their jobs. So technically, it's a low hiring event. Companies aren't laying off a ton of people, but they're not hiring a ton of people either. They're just kind of waiting and seeing, just like the Fed is, just like consumers are with these big ticket purchases. They just keep on pushing it down the road until we get more clarity as to what's going to exactly happen. Now, with this low hiring being the narrative right now, there are no terrible concerns yet in the labor market, but Claudia Psalm, chief economist at New Century Advisors, sees this being trouble if layoffs do start to happen because the already low hiring rate, married with extra costs and uncertainty hitting companies, could mean that the unemployment rate rises quickly, is what she says. And then I added this part. All right, well, companies start laying off and they're technically not hiring a whole lot. Then think about the impact that AI plays long term. I'd imagine AI longer term takes away more jobs than it creates, maybe. Now, I could be completely wrong, but if you think about it, jobs who have employees with employees who learn how to use AI to the benefit of their job positions are able to do more and be more productive. So maybe one person could do the job that maybe 3 people did. Like imagine your job's just to knock out emails. How many more emails could you knock out thoughtfully with AI, just for an example? So this will allow less people to do. That would allow more people to do more work, and that just fuels the fire to this labor market. So that is part two with this stagflation worry: is the labor market longer term, especially if we start seeing cracks in the labor market to where companies have to start laying people off and the unemployment rate increases. And this the job market, like it's not terrible, but for people looking for jobs right now, it's not like the greatest time to be looking for jobs. So there's truly some weakness in here. And then economic growth, that's the third factor into the stagflation worry. And if we just kind of think about what we've been talking about this entire time with the inflation expected to be a little bit higher due to these crazy tariffs and the government spending, inflation's high and costs are high. So that's a form of a cost being high. And also the labor market. The labor market's not necessarily terrible, but it's not like booming crazy either. So it's just kind of like chilling right now. But with borrowing costs being high, which is another type of cost built into things, businesses may be less likely to want to invest into inventory or employees, which goes into the low hiring aspect. That could lead to slower economic growth altogether because then businesses are spending less on both inventory and people, manpower to um, fulfill these goods or service needs that exist out there, or maybe there's even less demand, so less need for workers. And then consumers spend less money. So altogether, that's slower economic growth, and that, ladies and gentlemen, is where the stagflation worry truly fulfills and becomes scary. And what is the Fed doing to that extent? Do they cut rates? Because cutting rates would stimulate the economy and make inflation rise, right? So that wouldn't be very good. And as you could see, I bet it gets a little bit more detailed than I'm willing to go for this video, but that's just a worry sitting on people's minds. And then us in the US, what is our money based out of? Well, for a lot of the world, what is the global currency, reserve currency? It's the US dollar. And back to back to back, there are a ton of US dollar being weakened and expected to decline over time. So there's this article on Forbes by Randy Watts, and it's talking about the USD weakness. And pretty much what they're talking about are there are several reasons for this decline. First, the U.S. debt levels continue to rise, forcing the U.S. Treasury to continue to issue more notes and bonds, these IOUs. You have to offer a yield to get people interested to even do that, right? Because there's this opportunity cost. Why would I give you money when I could like go in this stock market and look at Tesla today? Like I could have made 4% today versus 4% in a year. Like think about that. So there's an opportunity cost. This oversupply of US debt has weakened the dollar. Also, the ongoing trade turmoil has reduced the demand for dollars from US trade partners. The US runs a large financial account surplus. However, if international trade dislocations continue, the US is likely to see lessening demand for the dollar and US financial assets. This would represent a meaningful trend reversal from the last 5 years that we've seen. Finally, the expectation of the Fed easing later in the year has also impacted the demand for the currency. And then it goes on to talk about the dollar's movement has a significant impact on foreign demand for U.S. financial assets. When the outlook for the dollar is positive, meaning an expected increase in relative value versus other currencies, so the U.S. dollar goes up in value, demand for U.S. financial assets and real estate tends to rise. Conversely, when the outlook calls for dollar weakness, foreign buyers often reduce their purchases of dollar denominated assets. And think about it, if you're expecting the dollar to go down in value, you're not gonna like just hold the bag. That's like, man, like I'm expecting Nvidia to go down because of these restrictions on AI chips. Like I know this is gonna happen and it's gonna be some noise. Like, why not just like go somewhere where it's not gonna do that? Like Tesla. So think about currencies like that. Like, why hold the US dollar when I could just hold like the Japanese yen or the Chinese yuan or something? not not an exact example of what you should do. That's just an example entirely. Now back to this article. However, a declining dollar often coincides with Fed rate cuts, which can boost corporate earnings, particularly among U.S. multinationals whose overseas sales are translated into higher dollar profits. Now, I just thought this was interesting. Fed rate cuts which can boost corporate earnings. And this goes back to what we were talking about earlier with the S&P 500 at 22 times expected earnings for what analysts believe the S&P 500 is expected to do. And if these tariffs are deemed illegal or whatever and they just go away, that would be good for corporate earnings. If the Fed decided to cut rates, which let's see where we're at for this year, we're expected 2 rate cuts. Let's see how September's looking. We could load. All right, 54.1% chance. All right, so it looks like September's still on the table, you know, unless CPI comes in really hot, we could see this number go down. What about December? Ooh, so this has dropped below 40. I mean, it's still the highest that we're, yeah, so the highest prediction here is still that we get 2 cuts of each 25 basis points or 1/4%. So a 1/4% cut twice this year is what we're still expecting to happen. But I mean that would be good for economic growth and expansion and corporate earnings as well. So if you're expecting the S&P 500 and these other stock indices to continue performing well, then I guess that's got to be your base case, because with stocks near an all-time high, with earnings expectations like at near all-time highs already, and interest rates and borrowing costs are high and inflation is expected to be high, I don't know that that necessarily justifies higher returns in these stocks. Now, let's talk about one last thing, because the US trade deficit and the dollar have really been on everybody's minds lately, especially with this trade talk between the US and China. And what this article is really talking about is what they see for the dollar and what could really pull the dollar like out of the grave and continue performing well. So it's by John Sindrew. Will America's unbalanced trade doom the dollar? And what they go on to talk about is America's trade deficits are a problem and might not stabilize for a while. Not until we see imports and exports realign, because they've completely been out of whack from this trade war that's been going on. And the link with the budget deficit is clear. If on net companies and consumers spend more abroad, demand is weaker at home and unemployment could rise. We were just talking about unemployment, right? So the government has an incentive to fill the gap through fiscal spending, and think about things like the big beautiful bill or cutting tax. Yeah, where they're spending money or cutting taxes in a way, anticipating inflation to occur. Central banks in importer nations keep interest rates higher. So think about the US, we import more, so we buy more from others that we bring into the country versus selling to other countries that we send out. So we're an importer nation and we keep interest rates higher is what it says here. As trade deficits widen, the dollar weakens and is what happens boosts the value of US assets held abroad, because if you think about it, they're a bit cheaper. Like if the US dollar went down, what happens when the US dollar goes down? Let's just say the euro goes up a little bit. So the euro is able to buy more US goods or US assets. While the US dollar being the global reserve, economists argue that exporter nations such as China, for example, with excess savings, invest into these US assets, like I just said, and will result into capital inflows, keeping the dollar overvalued, forcing either the federal government, or Americans themselves to take on excess debt to keep the ball spinning. When foreign countries sell more to the US than they buy, they end up with dollars in cash, which makes sense. I sell you this mouse, you're going to give me money for it, right? But this is just, which is a US liability if you think about it. But this is just a payment for a purchase. It's not like the US importers are literally borrowing money from overseas. The foreigners take their money and buy US stocks, which have performed well. And this article's take is that as long as the dollar's performance is dependent on these stocks, and as long as the Magnificent Seven continues to perform well, the dollar isn't necessarily